If you're a solopreneur making $500,000 to $1 million a year, you're probably working with a CPA. And your CPA is probably doing their job well, filing accurately, keeping you compliant, making sure you don't get audited. But here's the question I ask every new client. Are you and your CPA having proactive multi-year tax strategy conversations? Or are you just filing and reacting? Because there's a huge difference. And that difference can cost you or save you tens of thousands of dollars every year. I'm Gabe Nelson. I help high-earning solopreneurs stop overpaying in taxes, build wealth that compounds automatically, and create the option to make work voluntary on their timeline. And in this video, I'm going to walk you through the 3 tax strategies that can transform your wealth, but only if your tax planning is proactive, coordinated, and multi-year. These aren't loopholes. They're not aggressive. They're just strategic. Let's dive in. A few years ago, a client of mine came to me. Let's call him David. David was a fractional CFO, brilliant guy, making $850,000 in annual revenues, S-corp structure, solo 401k, everything by the book. His CPA had been with him for years, filed on time, no issues. But when I asked him, what's your tax strategy for the next 3 years? He looked at me like I'd asked him to solve a calculus problem. He didn't have one. And that's not unusual. Most solopreneurs operate on a 1-year tax cycle. January through March, they scramble to minimize last year's taxes. April, they file. May through December, they don't really think too much about taxes. And then they repeat. But taxes aren't a 1-year game. They're a multi-year, integrated, strategic game. And when you only think 1 year at a time, you miss opportunities that only show up when you zoom out. Here's what I mean. David's CPA was handling the essentials, filing his S-corp return, making sure his reasonable salary was defensible, calculating his solo 401k contributions and matches, and keeping him compliant, but nobody was asking the strategic questions. Should we layer a cash balance plan on top of the solo 401k? Should we do a Roth conversion this year while his income is lower? Should we shift some income into next year to avoid a bracket jump? And should we coordinate distributions with your investment timeline? Not because those questions aren't important, they are, but because nobody was asking them. Not the CPA, not David, not anyone on his team. And that's the gap. The first strategy is multi-year tax bracket management. Here's the idea. Most solopreneurs think the goal is to pay the least amount of taxes this year. But sometimes paying a little more tax this year saves you a fortune over the next decade. Let me explain. Let's say you're a solopreneur earning $600,000 a year and you're in a 35% tax bracket. You're aggressive about deferring income, maxing out your solo 401k, maybe even a SEP IRA. Great. You're deferring $70,000 a year into tax-deferred accounts. Let's fast forward 15 years. Now you're retiring, you've got $1.5 million in tax-deferred accounts. And when you start pulling that money out, every dollar is taxed as ordinary income. If you're pulling $100,000 a year to live on, you're still in a high tax bracket. Plus, at age 73, your required minimum distributions kick in, whether you need the money or not. Suddenly, you're forced to take $60,000 to $80,000, maybe even $100,000 per year out of those accounts, and it's all taxable. Here's the math most people don't realize. Let's say at age 73, your RMD is $100,000. You're also taking Social Security. Let's call that $40,000. You also have some rental income. Let's say $30,000. Total taxable income is $170,000. You're now in the 24% federal tax bracket plus state taxes. So that $100,000 RMD you're paying, $24,000 in federal tax alone, and you didn't even need the money. The IRS just forces you to take it out. That's a future tax subscription you're signing up for right now, and you didn't even know it. So here's what we do instead. We look at your income over time. If you have a year where your income dips, maybe you took a sabbatical, or you had a slow Q4, or you're transitioning your business model. That's a golden opportunity, because in that lower income year, we can do a Roth conversion, move money from your tax deferred to tax free at a lower rate. We can accelerate income, recognize revenue you were going to defer but at a lower bracket. Or maybe even we can harvest capital gains, take gains at 0 or 15% instead of waiting until you're at 20%. The goal isn't to minimize taxes this year. The goal is to minimize your total lifetime tax burden. So let's go back to David. In year 2 of working together, he had a slow Q1. He'd lost a big client and revenue dipped to about $550,000 for the year. His instinct was panic, cut expenses, defer everything. But I saw it differently. I called a CPA and said, this is the year we do a Roth conversion. We worked together to model it out. We moved $80,000 from his traditional IRA into a Roth IRA. Yes, he paid tax on it that year. It was about $28,000. But that was $80,000 that will grow tax-free for the rest of his life. And when he's 65 and pulling money out, 0 tax. And if we'd waited until he was in retirement and forced to take those RMDs, that same $80,000 could have been taxed all the way up to 35%. So instead of paying $28,000 in tax, he would have paid close to $50,000. We saved him $22,000 by paying tax strategically in a lower income year. Multi-year tax planning means asking, what bracket am I in this year? What bracket will likely I be in next year? And what bracket will I be in during retirement? And then we move money intentionally across those brackets to minimize the total. This is the kind of conversation you should be having with your CPA on a regular basis. If you're not, it's worth asking, can we start looking at tax strategy over multiple years, not just one? So the second strategy is layering retirement vehicles to maximize contributions beyond what most solopreneurs think is possible. Most solopreneurs I meet are maxing out a solo 401k already. Maybe they're putting $70,000, $75,000 a year and they think that's the limit. It's not. If you're making $800,000 a year and only deferring $80,000, you're deferring less than 10% of your income. That's not enough to build serious wealth, especially if you're in your 40s and 50s and trying to catch up. So here's the math. Let's say you're 50 years old. You want to retire at 60. You're earning $800,000 a year. You're maxing out a solo 401k at $80,000 a year, which is the 2026 limit with catch-up. Over 10 years, assuming a 6% growth, your total contributions would be $800,000. Total value at 60 would be around $1.08 million. Now let's say your freedom number is $3 million. You're $2 million short. You'd have to work another 10 years or take on significantly more risk to close that gap. This is the contribution gap, and most solopreneurs don't realize they're in it until it's too late. This is where the cash balance plans come in. A cash balance plan is a type of defined benefit pension plan. And when layered on top of a solo 401k, it can allow you to contribute $200,000, $250,000, even $300,000 plus per year in tax-deferred retirement accounts, legally, compliantly, and strategically. So here's the structure. Let's say you're 52 years old, earning $750,000 a year, and you want to accelerate retirement savings. You're already maxing your solo 401k at $80,000. That's the 2026 limit with catch-up, but you want to do more. So what we do is we layer on a cash balance plan on top of it. Now, based on your age and income, you can contribute an additional $180,000 into the cash balance plan that year. So your total annual contribution for the year would be $260,000. That's a $260,000 deduction. At a 40% effective tax rate, that's saving you over $100,000 in taxes that year. So here's where it gets crazy. Let's model this over 10 years. Scenario number 1, your solo 401k only, 80 grand a year. Total contributions, $800,000. Total value at age 60 with a 6% growth. That's conservative, $1.08 million. So scenario number 2, solo 401k, cash balance plan on top, $260,000 a year. Total contribution, $2.6 million. Total value, 6% growth at $63.55 million. That's a $2.5 million difference. Same 10 years, same career, same business, just a different retirement vehicle structure. That's the power of layering. So I had a client, let's call her Maria, who did exactly this. She was a solopreneur consultant, 54 years old, earning about $900,000 a year. She'd been maxing her solo 401k for years, but she felt behind. So I brought the idea of a cash balance plan to her CPA. We worked together to set it up and make sure it was coordinated with her overall tax strategy. Year 1, she contributed $285,000 into her retirement accounts. Her tax savings $114,000. Over 5 years, she deferred over $1.2 million in tax advantage accounts. And because she was strategic about it, she didn't just defer, she invested that money into a diversified portfolio designed for long-term growth. By the time she hit 60, her retirement account had grown to over $2.3 million, all because we layered these vehicles instead of staying stuck in the solo 401k limit. Now, cash balance plans are not for everyone. They require consistently high income, $300,000 plus annually, ideally each and every year. A 3 to 5 year commitment, annual actuarial work, which costs $2,000 to $5,000 a year, and you have to have the discipline to fund it every year. But if you're a high-earning solopreneur who wants to catch up on retirement and slash your tax bill, this is one of the most powerful tools available, and it's absolutely something your CPA should be aware of and helping you to evaluate. Don't assume the solo 401k is your ceiling. If you're earning $500,000 plus, there are strategies to defer 2 times, 3 times, even 4 times more than you think. You just need to make sure someone on your team, whether that's your CPA, your financial advisor, or both, is bringing these options to the table for you. The third strategy is entity structure optimization. And this is one of the most overlooked areas in solopreneur tax planning. Most solopreneurs start as an LLC. Then, when they hit that $200,000 to $300,000 in revenue, someone tells them to elect S corporation status, usually their CPA. And then they do, and it works, and they never think about it again. But your entity structure shouldn't be static. It should evolve with your business. I see solopreneurs stuck in S corp structures that made sense 5 years ago, but don't make sense anymore. Or they're still operating as LLCs taxed as sole proprietors, paying self-employment tax on everything. Both are leaving money on the table. So here's the math most solopreneurs don't realize. Let's say you're operating as a sole proprietor. Maybe you're an LLC taxed as a sole proprietor as well. You're earning $600,000 in net profit. Self-employment tax rate is 15.3% up to the Social Security wage base of $184,500 in 2026, plus a 2.9% Medicare tax on the rest. So let's calculate it. Your first $184,500 times 15.3% is a little more than $28,000. The remaining $415,000 at 2.9% is another $12,000. So your total self-employment tax is going to be just over $40,000. That's nearly $40,000 you're paying just because of your entity structure. Now let's say you elect an S corp status. You pay yourself a reasonable salary of $150,000. The remaining $450,000 comes out as a distribution, not subject to self-employment tax. Payroll taxes on $150,000, let's use the same 15.3%, is $22,950. Self-employment tax savings, you go from $40,000 to just under $23,000. That's about a $17,000 tax savings that year. Over 10 years, that's $170,000. That's the cost of not optimizing your entity structure. But here's what most people don't know. Your reasonable salary should be reviewed every year. If your income jumps from $400,000 to $800,000, your salary probably should increase too. If you're paying yourself $80,000 on $800,000 in profit, that's probably going to raise some red flags. Conversely, if your income drops, you might be overpaying yourself and limiting your flexibility. This is something you should be reviewing with your CPA on an annual basis. Most solopreneurs assume C Corps are only for real companies with employees and investors. Not true. In specific scenarios, a C corporation can be incredibly powerful. So here's where it gets crazy. Qualified Small Business Stock, QSBS, allows you to exclude up to $10 million in capital gains from federal tax if you structure your business as a C Corp. You hold the stock for at least 5 years, and the company qualifies as a qualified small business. That's $10 million of a tax-free gain. At a 20% capital gains rate, that's a $2 million tax savings right there. So let me tell you about a client. Let's call him Jason, who was operating as an S Corp and making about $650,000 a year. But he was also building a SaaS tool on the side, software as a service tool. He wanted to pour $150,000 to $200,000 back into the development, but as an S-Corp, he was taking distributions to cover his lifestyle and then paying tax on those distributions as well. So I sat down with Jason and his CPA, and we talked through the idea of restructuring part of his business into a C-Corp. His CPA ran the numbers, and we all agreed it made sense. So now the SaaS income stayed in the C-Corp, got taxed at 21%, and he reinvested it without taking personal distributions. Over 3 years, he built the tool, scaled it, and eventually sold it for $2.8 million. Because we structured it correctly under the QSBS rules, working closely with a CPA and attorney, he excluded $2.8 million in capital gains from federal tax. That's over $600,000 in tax savings from entity structure alone. Your entity structure is not a one-time decision. It's a strategic lever you should revisit every 2 to 3 years as your income, your business model, and your goals evolve. This is exactly the kind of conversation you should be having with your CPA. If you're not, it's worth asking. Should we review my entity structure to make sure it's still making sense? It's questions like that you should be asking your CPA on a regular basis. The best CPAs I work with are absolutely thinking strategically like this. In fact, some of the most sophisticated tax planning I've seen comes from the CPAs my clients work with. The difference isn't that CPAs can't do this work. It's that it requires a different type of an engagement. Here's what I've learned over 30 years. The best financial outcomes happen when you have a team that collaborates. A strategic CPA who understands multi-year planning and proactive tax design, a financial advisor who integrates taxes with retirement, investments, and cash flow, and regular coordination between the two. When I work with clients, I'm constantly talking to their CPA. We're asking each other, should we do Roth conversion this year? Does a cash balance plan make sense given their goals? Should we shift income between years? How does this entity structure decision affect their 5-year plan? That coordination is what unlocks these strategies. The challenge isn't capability, it's engagement structure. Most CPA relationships are built around annual tax preparation, quarterly estimates, compliance and filing, and that's really valuable. That's essential. But proactive, multi-year, integrated tax strategy requires a different type of relationship. It requires quarterly planning meetings, scenario modeling, coordination with your financial plan, ongoing communication throughout the year. And honestly, most solopreneurs don't ask for that level of engagement. They assume the CPA will just tell them what to do. But the best CPAs I work with, they're waiting for the client or the advisor to initiate those conversations. They love these conversations. So here's what I'd encourage you to do. If you have a CPA, ask them, are you open to collaborating on multi-year tax strategy, not just annual filing? If the answer is yes, great. You've got the right partner. If the answer is that's not really what we do, that's okay. But it means you might need to add someone else to your team who can. Because these strategies, Roth conversions, cash balance plans, entity structure optimization, they don't happen in a vacuum. They happen when your CPA, your financial advisor, and you are all working from the same plan. So let's recap the 3 strategies we covered today. 1, multi-year tax bracket management. Pay strategically in lower income years to save long term. 2, layering retirement vehicles. Use cash balance plans to defer $200,000 plus annually. The example we used was $260,000 a year versus $80,000, which has created $2.5 million difference over 10 years. Number 3, entity structure optimization. Revisit your structure every 2 to 3 years as your business evolves. Remember the example, the qualified small business stock exclusion, up to $10 million of tax-free gains. These aren't tricks, they're not aggressive, they're just coordinated. And when done right, they can save you tens of thousands, sometimes hundreds of thousands of dollars over your career. So if you want to know whether you're leaving money on the table, ask yourself these 3 questions. Have I done a Roth conversion in the last 5 years? Am I deferring more than 15% of my gross income into retirement accounts? And has anyone reviewed my entity structure in the last 3 years? If the answer to any of those is no, you're probably missing some opportunities. If you want to see how all of this fits together, taxes, retirement, cash flow, wealth building, I've put together a comprehensive guide called the Scaling Wealth Blueprint. It's specifically designed for solopreneurs making between $500,000 and $1 million a year. And it walks you through the exact systems I use with my clients to coordinate everything instead of optimizing in silos. You can download it for free. Links in the description below. I've been doing this for 30 years. And the solopreneurs who build the most wealth aren't the ones who earn the most. They're the ones who coordinate the most. Your CPA should be a strategic partner in this. And if they're not set up to engage that way, that's okay. Just make sure someone on your team is. The best time to start was 3 years ago. The second best time is right now. Thanks for watching. I'll see you in the next one.